The stock of property listed for sale, the total number 25,500 at the end of June, was down 14% from December. So I'm trying to highlight that already what you can pick and choose from, it's going down. And then I thought, I'll have a look at what this is for different places around the country. Hello again, everybody, and welcome to another Tea with Tony, without the tea by my side. On a monthly basis, I do this with NZHL, and this is where I have a look at what's happening with interest rates, if I were a borrower, maybe what I would do, what's happening in the economy overall, and of course have a look at what's happening in the housing market, something for which I've got some unique insight, I guess, with those surveys that I do of real estate agents, mortgage advisors, etc. Now, what I thought I'd start with for this month is just a quick look at, I guess, an issue which might have confused people a little bit over the past few weeks. We've seen banks increasing their fixed mortgage rates without any extra increase in the official cash rate, tightening of monetary policy from the Reserve Bank. In fact, even with the Reserve Bank fairly strongly expressing confidence that they won't have to increase the cash rate again from 5.5%. What's happened here is that the cost to banks in New Zealand of borrowing money to lend fixed has gone up, not because of anything happening in New Zealand, but because of some extra worries about inflation in the United States. By and large, their labour market is proving to be very strong, and so people are thinking, well, maybe the wages growth is going to be higher than the Federal Reserve have been allowing for, and so maybe some extra monetary policy tightening over there beyond what people were thinking about 2 or 3 months ago. So that's the main reason why we've seen these rates go up here in New Zealand. And where we sit now, the margins which banks are getting on the likes of 1, 2 and 3 year fixed rates are at about their average levels for the past couple of years. 4 and 5 year margins for banks are still below average, so they still could increase those further. However, no one's really borrowing out there at those terms. Everybody's looking at the 1 year, 2 years, and 18 months, of course, is quite popular out there as well. In terms of where interest rates are going to go in New Zealand, of course, it all comes down to inflation. And in that regard, we still exist in quite a state, I guess, of uncertainty. I wouldn't necessarily use the word confusion. We are aware of the factors in play, but there are these unique, I guess, aspects of this environment we're operating in, all of us, one way or another, which I've spoken about before. And I just want to give a little reminder about some of those factors. The key one is that just as 3.5 years ago, none of us had lived through a pandemic before, so we did not know at all what normally happens when you have a pandemic. Now we are in this unique post-pandemic environment. None of us has ever lived through a post-pandemic environment before, so we really do have to allow for things not necessarily playing out as we might, predict, forecast, our models might suggest, those sort of things. So that's the first element of high uncertainty. Secondly, normally when you have a recession, and we have seen our economy in New Zealand shrink about 0.7% late last year, early this year, normally, as in all previous recessions, the job numbers go down. No, this time they've gone up by 1.3%. I mean, we do expect that employment will ease off a bit. The unemployment rate will go up over the next 12, maybe out towards 15, 18 months. But so far, the labour market is uniquely tight, and that means maybe there's more transfer through of the shock increases in prices into wages than would normally be the case. And certainly private sector average ordinary time earnings is the key measure most of us economists look at. In the private sector, up by about 7.6% in the past year. So there has actually been a fairly strong and quick pass-through of higher cost of living increase, etc. in New Zealand into wages. So that labour market uncertainty, of course, is going to remain around for quite some time. We've got this migration boom, a 1.5% boost to our population in the past year with a net extra 78,000 people. What that does for inflation is actually very hard to figure out, because we can already see that it's having an impact in the labour market. Businesses are expressing greater ease of finding especially unskilled people. Their ease of finding people there is better than average over the past 10 years. Finding skilled people, it's now retreated to about as tough as average over the past 2 years from being a few quarters ago. Amazingly tough, record levels of toughness of trying to find those skilled people. people. So a few more people sloshing around is leading to some easing pressures, good for the business sector there. So you might look at that and say, okay, that means inflation's going to fall away. Maybe the Reserve Bank will signal an easing of monetary policy soon. Not so fast, because extra people need somewhere to live. And I can see from one of my monthly surveys that investors, people who are already owning residential property, are finding it relatively easy to get good tenants. And this has been a very strong turnaround over about a 6 or 7 month period with these extra people sloshing around. There's a lot of debate about this in Australia in particular, where they've also got a migration boom, an extra 400,000 people record over the past year, and high awareness of what that is doing to their rental markets, the rents, especially in the capital cities. Here in New Zealand, we had Trade Me the other day saying that their measure of rents being asked on their website in June, on average, 9% higher than a year earlier. So we've got some extra inflationary pressure there from the migration boom on rents versus some downward pressure on wages growth. And of course, we really don't know how that is going to pan out over the next wee while. I usually run through a few other areas of uncertainty, but there's enough to make the Reserve Bank just be cautious, I think, before they signal any intention of easing interest rates. But I think we can all be confident that inflation, the inflationary pressures, are moving in the right direction. We've got the annual inflation rate now down from the peak last year of 7.3%. We sit at 6%, and you might go, okay, it's falling away. That's a good thing. Yes, but we calculate underlying measures of inflation where you take out things which have maybe moved in price outside the norm for weird reasons. We look maybe at just what's traded in New Zealand. It's called tradable inflation, to try and get a feeling of what is happening in underlying measures. And unfortunately, there's a measure which the Reserve Bank expected to be 6.3%. It's still 6.6%. So, they place a lot of weighting on that. They're not going to be feeling in a hurry to ease monetary policy anytime soon. But then we've got other measures, such as from the ANZ Roy Morgan Consumer Confidence Survey they do every month. A couple of months ago, on average, consumers were saying in 2 years' time, we think inflation is going to be 5.2%. Now people are saying it's going to be 4.3%. So moving in the right direction, definitely, but not necessarily at a rapid pace. And there's a few other measures I could cite there, but what they add up to is that the inflationary pressures are moving in the right direction, but the Reserve Bank's probably not going to signal an easing for some time. Most of us expect the first cut to the official cash rate will come sometime in 2024. The Reserve Bank has penciled in around about October. Most of us think before the middle of this year, next year. We'll simply see how that pans out. I think there's a reasonable chance that late this year we do start to see some downward movement in the likes of the 12, 18 month, 24 month fixed mortgage rates. But like I say, a lot of uncertainty out there at the moment. What's interesting, of course, is in the housing market. It's bad enough we've got this uncertainty regarding inflation, and it's exactly the same situation in Australia, the UK, Eurozone, United States, etc. Despite the big increase in interest rates over the past 9 months in particular, and the past 2 to 3 months, what we have seen is that the housing market appears to have bottomed out, and we can see sales which have risen, seasonally adjusted, 20%. For dwelling sales around the country in the June quarter. Prices on average were flat in April and May, and then they rose about 0.7% nationwide in June. So I think we can say that the housing market, the real estate market, not construction, but real estate market has bottomed out. And that would sort of make sense in that there's a general consensus overseas, for instance, that in February, the Australian market bottomed out, and I think the Canadian market is judged as having bottomed out there as well. So for us, around about sort of March, April, May sort of period, it seems quite easy to understand in that international context. Now, we've got other measures here showing improvement in the market, and one of them, of course, I get from my survey of real estate agents, and that is FOMO, fear of missing out. Ever since early 2022 up until recently, only about 4 to at best 9% of agents have said, I can see agents, buyers worried they're going to miss out. Fear of, like I say, missing out. Maybe they worry prices will go up or the listings won't be there. Now that's 19% of real estate agents showing that, and I would expect that to keep increasing from here. I also have a measure of whether we're in a buyer's or a seller's market. Nationwide, a net 8% of agents say we are still in a buyer's market where the buyers have the greater power in the negotiations. Not in Auckland. In Auckland, a net 4% of agents are saying actually the sellers seem to have the greater ability to negotiate there. So we've already switched towards a seller's market up in Auckland, and I think the rest of the country is going to follow over time. One thing I haven't mentioned before, I'm fairly soon, I was writing a column 2 or 3 days ago, and I was referencing something I've mentioned many times, the stock of property listed for sale, the total number, 25,500 at the end of June, was down 14% from December. So I'm trying to highlight that already what you can pick and choose from, it's going down. And then I thought, I'll have a look at what this is for different places around the country. Now, in Christchurch, the stock of listings has fallen 10% from the peak, which was in March. But the more interesting areas would be in August last year. We saw the peak in the number of properties listed for sale in Auckland. It's already down 18%. Wellington also peaked in August last year, down about 44%. And hence the newspaper report a few days ago of a traffic jam, I think it was in the suburb of Newlands, all these people showing up for an open home of apparently a particularly good property. People are starting to feel that the property is not necessarily readily available. And this is something which will start to occupy people's minds a bit further out. Now, in terms of the housing market bottoming out, so far we can put it down to the first home buyers stepping forward. And they've been stepping forward for a number of reasons. I think I've covered a few times in the past few months. People have built up deposits over this period of time since the prices started falling late in 2021, or even as they stood back from the market in early 2021, because there simply wasn't much to choose from. It was difficult to basically find something to buy. So the deposits are larger. The rents, of course, are rising, so there's that sort of push factor to have a look at something else. The incomes have gone up quite well. Over the past 3 years, on average, our cost of living has gone up about 18%. Average wages have gone up about 18%, but I suspect it's more for young people who tend to move from one employer to another, and the rule of thumb in New Zealand at least is that is how you get the best wage income increase, not from your existing employer, but by moving to somewhere else. So I tend to think maybe that this has contributed to, like I say, the deposits improving, and of course the prices are down nationwide on average 18% from the peak at the end of 2021. Auckland and Wellington down by about 24% from the peak. Christchurch down about 10%. Or so. So we've got the first home buyers moving into the market, but as I've highlighted for some time, the investors no, they're definitely not moving into the market there. And I can look into the bowels of one of my surveys there, which doesn't capture all that many young people, and that allows me to say the owner-occupiers, people already with a house, they're not yet looking to buy and sell or sell and buy. The real bread and butter stuff for the real estate agents there, that looks like it's still to come along. So we've got these factors in play so far that have brought the first home buyers into the market. I guess my greater interest is in the other factors which are going to come into play at uncertain times over the next sort of 6, 12, 18 months, which for me, from my point of view, I expect to cause average prices to rise or be about 5% higher at the end of this year than the end of last year, and increase maybe 10% over to 2024. And you may notice that generally out there's a bit of a shifting in people's predictions of what prices are going to do. So I'm just going to finish up with these 4 key factors that I've noted here. Number one, a few months ago I mentioned that I'm using these 3 words at the start of many of my columns: at some stage. And the key one here is that at some stage, people are going to remember that a migration boom pushes up house prices. At the moment, a lot of people are still despondent about the New Zealand economy and focusing on the loss of Kiwis across to Australia, not yet factoring in enough that we're getting untold people coming in from other parts of the world. So at some stage, that migration awareness and then the linking through to what it's done with house prices in the past will kick into action. I think that's definitely a story for 2024, and there could easily be elements of that later on this year. Secondly, housing market's improving while interest rates are still rising. What's going to happen once the interest rates start falling from some point next year? Well, we know basically once the interest rates are coming down, as long as the economy is not heading into a new deep recession, you will find more people able to afford housing. With the stress interest rates, 9.5%, they start coming down. People can find, they can get the finance from the bank and make a transaction. So that one is to come along, and it's a story for 2024. Thirdly, at some stage, people are going to realise house construction is falling away really quickly. Standalone housing construction is already falling. The bigger falls in a house construction cycle occur with multi-unit developments, groups of townhouses, apartments, etc. And that has yet to really get rolling out there. At some stage, people will realise that at the same time as population growth is accelerating, the number of new builds coming onto the market is going to be falling for probably the next couple of years. And then just the final thing to finish up on, the political polls were already starting to suggest that maybe we could see a centre-right government from October 14 as a result of some of the events in Wellington there in the most recent weekend. I expect the polls are going to be shifting around a little bit more. The journalists are starting to feed on, no one's called it a carcass as yet for the Labour government, but you can see the turning in the sentiment out there. The relevance for ourselves, of course, is that investors sort of have no interest in the market, but one National Party policy is that they would restore interest expense deductibility. And I can see from all of my surveys that when that tax rule was changed March 27, 2021, it just had a major impact on the presence of investors as buyers in the market. So I would expect a whipping back, not to the same magnitude, but definitely a restoration of investor interest in the market. So the election outcome is going to have an impact on the housing market. If Labour retain government, then I would expect to see more investors moving out of the market, because we'll be facing another 25% of interest expense deductibility disappearing and the interest rates relatively high. So that is going to be relatively important, I'd suggest, for the housing market overall and the sort of momentum we develop through 2024, this general election coming up on October 14. So look, thanks everybody for looking at this. I hope you're making your way not too badly through winter there. And just a reminder that these are my personal comments. I'm not providing financial advice, and these comments do not necessarily represent the view of NZHL. Nothing is intended to be personal advice. Go out and do your own research, and just remember, I try and pump out as much information for you to do your own research in a publication, Regional Property Insights, I put out. There's the monthly surveys of real estate agents, mortgage advisors, residential property investors, businesses and consumers as well. Also, I've got my weekly Tony's View publication, and you can just go to my website, tonyalexander.nz, and sign up for that free weekly thing on the front page there if you like. So thanks very much for listening, watching, and all the best. Cheers.